Now that Canadian mortgage interest rates are tickling 7%, and it looks like not only will rates increase soon, but central banks that said rates would stay low for a long time are now saying that rates will stay high for a long time. And last week here on the channel, I put out a video warning you that if rates do stay high for another 3 to 5 years, that, well, the Canadian real estate market could be in trouble. And if the Bank of Canada does what they say they're going to do, which, by the way, they most often don't, then you as a homeowner with a mortgage in Canada are going to be in for a very big surprise in the coming years if you don't take action now. Yeah, it's true. If you don't pay attention, take action, and this is the key, if mortgage interest rates stay above 6 or 6.5%, then you have the potential of losing your home. And if you don't want to lose your home and you're interested in finding out what you can do to not get financially destroyed if the worst case scenario were to play out, well, then you're going to want to watch this video all the way to the end. But speaking of home prices and the possibility of them declining, the Fraser Valley Real Estate Board just released their most recent housing statistics, and that makes this the Surrey Report. So before I try and save you from the impending doom of the market, here is my amazing team with the latest prices for the City of Surrey.
Looking at our detached market, we had 170 sales in September. That is a 36% increase from the 125 sales in the same period last year. Our benchmark price is $1,671,900. That is down 0.2% month over month and up 4% year over year.
We had 170 townhouse sales in September. That's a 31.8% increase over this time last year. Our benchmark price is $883,500. and that is a 0.2% increase month over month and a 6.2% increase year over year.
And in condos, benchmark price is around $539,000. Now that's a 1.6% decrease month over month, but a 3.8% increase year over year.
Well, there you go. I wasn't personally expecting to see prices stay that flat this month, but the market is continuing to be a crazy, wild, and unpredictable beast. In fact, the only thing more wild than the Canadian housing market is the fact that only 35% of you watching right now have even subscribed to the channel. And although I cannot accurately predict for sure that the market is about to go through a tough couple of years, I can predict that if you click the like button for the YouTube algorithm, that you will help promote this video to other Canadians just like you, and then they can use this information from this video to stop them from becoming homeless in the future. So thank you for both subscribing and clicking the like button. And now on to the latest episode of Pull Your Head Out of Your Ass. Higher payments are coming your way. So as I pointed out in last week's video, that I will for sure link at the end of this video, house payments for mortgagees are going to increase. There's just no bones about it. And if we see the worst case scenario, that means housing can increase on a month-to-month basis and housing values will go down. This could put you in a spot where you are unable to make your monthly payments and you can't sell with enough equity to clear your title. That is, unless you start taking action now to lessen the blow of higher payments later. Starting with the obvious, very obvious first step of spending less on the things you don't need and spending more on the things you do. Like, you don't need that new side-by-side quad, and you do need a roof to sleep under. And sure, that's easy to say, but what can you really do? Well, how about you start off with treating your current low rate, if you still have one, like it's a high rate. You see, if you bought real estate since 2018 or have qualified for a new mortgage, you have qualified as if your payment on your current loan was being paid back at an interest rate of 4.75 to 5.25%. So if your actual interest rate is 2.29% and you borrowed $500,000 over 25 years, your payment is around $2,190 per month. But if you were stress tested at the minimum 4.75% or more, if you now either increased or saved the difference in what your qualifying payment would be, well, you would be in much better shape in the near future, because that qualifying payment was at least $2,850 per month, meaning that you should easily, without any stress at all, be able to either pay down or save an extra $660 per month or more, because that's what you qualified for in the first place. Now, the ideal situation is this. You pay down with every extra $660 payment per month going directly onto the principal portion of your mortgage. Not only will you be reducing what you owe now, but also increasing the amount of principal being paid on the next or future payments, which then has a snowball effect and helps you save a ton over the course of your mortgage. But not all mortgages allow double up payments, like my personal mortgage with Manulife, which is a fixed rate product. So what that does is opens the door for savings of that same $660 per month and putting it down later on as a lump sum. The lump sum is less effective than making the payments now because it doesn't have that compounding effect of reducing interest. But it will help you have an overall lower balance when your renewal comes up in the future by taking your savings and putting it down against your principal. Most mortgages have easily a 10%, if not 20% of your original amount borrowed that you can put down as a prepayment or a lump sum. So check with your lender if you can increase or double up your payments, or if saving for a lump sum payment is a better option for you. Because the plan should be to get your balance down enough that when your renewal comes up, well, then not only will the new payment be less because you're starting to pay more now, but also those new, let's call them 6.5% to 7% interest rates that might be coming your way will be a lot easier to swallow due to your now reduced balance. And a smaller balance might keep you from having to do the less favorable option if you're in the situation where you're having trouble keeping your home or making your payments, and that would be to re-amortize. You see, when you get a loan, you pick your term that you want to carry your rate. Most often here in Canada, that is a 5-year fixed term. But you also pick your amortization or the lifetime expectancy of the loan. Because rates have risen so quickly, re-amortization, although I'm not a big fan of this option, might be the best situation for you. The reason it's not great is you will take longer to pay off your home than you had originally planned. But it could be your best option to keep you in your home and lower your payments. In Canada, if a mortgage is insured, it is most often carried at a 25-year amortization, or uninsured loans are often amortized over 30 years. If you got that same 2.29% loan for $500,000, like we talked about earlier, and you've amortized over 25 years, then at the end of your first 5-year term, your new payment from the bank will likely be calculated over 20 years. So that $2,190 payment now carries you a balance of $421,481. But now, with only 20 years remaining, and your possible new 5-year fixed rate could be as high as 6.5%, and your payment then could balloon to $3,142 per month if you failed to either increase or save the payments at your stress test amount. That almost $950 per month increase is going to shock you pretty hard if you haven't prepared for it. So I think what most people are probably going to do is see if they can get that loan pushed back out to 25 years, bringing that payment back down to as low as $2,845 per month, or even stretching it way back out if you can to 30 years in an effort to drop your payment down to the low new price, which is still high, at $2,664. Or after your first 3 years of paying $2.29, you just today start saving that extra $660 per month for the next 2 years. You could, at the time of renewal, put down a lump sum of an extra $7,920 upon the renewal, again in a lump sum payment, and maybe even reduce your payment to as low as $2,613 per month, which is effectively then lower than the stress-tested payment of which you qualified for in the first place. Meaning that yes, you should still have room to pay off your loan faster. And by the way, paying down faster is even more effective as your interest rate increases. And the last thing you should be seriously looking at in the coming years, if you haven't already, is quite frankly, you need to increase your income. Increases in income are happening kind of organically now, as unions are getting huge raises and private companies are having to pay top dollar to gain talent. Lower skilled workers are going to get absolutely crushed in the coming years of inflation and carbon taxation mania. Tons of people are getting huge raises, and you need to make sure you are one of them. So do whatever you can to make sure you are unexpendable to your employer. In the short term, and definitely over the coming years, skilled workers will be more valuable than ever. And unskilled workers are going to get laid off as businesses have to trim the fat in this high interest rate environment. And if you are unable to cut spending, pay down extra on your mortgage, save, re-amortize, or increase your income, well, then you have one last resort, and that is to sell. And if you do need to sell your home in Surrey or the Fraser Valley of BC, you can book a call with me right now using the link in the description below. Thank you for subscribing, clicking the like button, and checking out this video all about just how bad it might get.